Hello, this is Cliff Bogart, and I just want to take a few minutes to talk about something we may all be aware of, and that is, of course, what's happening in the commercial lending department, and in particular, situations that are coming up with commercial loan maturities, especially in the office market. So I've got a few headlines here about all of the commercial debt that is coming to maturity over the next few years. Office properties in particular have been getting a lot of attention. They're probably, well, without a doubt, that's the category that's most at risk. What it is, we're going to talk about some numbers and what we can do about it, and where there's also perhaps some opportunities. So a few factors to understand if you're new to commercial or commercial real estate is that commercial loans, unlike residential loans, have loan terms that are shorter than the amortization period. So a typical residential loan might have a 30-year amortization period, but also a 30-year term, meaning the lender is lending the money for the full 30 years. However, in commercial real estate, amortization periods, that is the amount of time we use to calculate the actual payment, may be 20 or 25 years. The loan term it may be much shorter, and usually is much shorter, 5, 7, 10-year terms, which means that's the length of time that the lender is actually lending the money. So although the payment is calculated as if it's going to be paid out over 25 years, for instance, the lender is only lending the money for 5 years, which means at the end of that, when the loan comes to maturity at the end of the 5 years, a balloon payment is due of the remaining principal balance, or the lender and the borrower choose to renegotiate the loan. This allows lenders to adjust to current interest rates, and in this situation, that is a big factor, because loans originated a few years ago, 5 years ago, 7 years ago, or even 10 years ago, if they had a 10-year term, that are coming due now are coming due in an entirely different lending environment. And again, I want to talk particularly about the problem area, which is office space. So not only are interest rates higher today than they were 2.5 years ago, 5 years ago, 7 years ago, what have you, because of the problems in the office market. And of course, we're probably all familiar with the problems in the office market, being the hybrid workforce, which was already coming on prior to COVID, certainly accelerated with COVID, and a lot of people aren't coming back to the office, and companies are going to permanent hybrid status and needing a lot less office space. And as these leases come to termination, companies may be renewing or relocating, but taking a lot less office space. So this is having a big impact, particularly on older office buildings with fewer amenities. That's perhaps a different discussion. But the problem with owners of these office properties, as their loans come to maturity, is refinancing, if they can get refinancing, is going to be at a higher interest rate. But not only that, with lenders now being more wary of office properties and the problems with office properties, are also revaluing those office properties at lower values based on higher vacancy, based on market conditions, etc. And this result is that many office owners are having to put, or facing a situation where they may have to put more money into the property, buy down the principal balance, so to speak, if they choose to continue owning and get refinancing for the property. So just to give you a little example, in this example, and I hope my picture doesn't obscure that, but in this example, a $3 million office property was purchased 5 years ago with 75% loan to value, 4.75% interest rate, 25-year amortization, and a 5-year term. So that's the loan they got 5 years ago. Well, it's coming to maturity. The original loan was for 75% of the $3 million, so $2,250,000. Therefore, at 4.75% and 25-year amortization, the monthly payments were $12,777, which made the annual debt service, the total amount that monthly payments over the year, $153,324. And the loan balance at the end of year 5, which let's say is coming up now, is $1,985,000. That's the balloon payment, or the amount that would need to be refinanced. So the loan matures next month in this example, and the interest rate for a new loan is 6.85% and a 20-year amortization. Again, lenders tighter constraints on what they're willing to do in terms of refinancing. So even if the lender agrees to refinance the full loan balance, that is the $1,985,000, the new monthly payments would be $15,125, which is significantly more than the $12,777. So that annual debt service jumps up almost $30,000 to $181,500. And so if the property is stressed, if it's an office property and it does have higher vacancy, maybe, and lower overall rents, lower net operating income, the property income, the net operating income, may not be sufficient to support that higher debt. Without mentioning it here, lenders are also scrutinizing the amount of debt, the debt service coverage ratio, et cetera, impacting the amount they would be willing to refinance. But in this case, even if the lender was able to refinance the entire $1,985,000 loan balance, the income might not be sufficient to cover the new annual debt service. So example part 2, kind of taking that a step further, let's say due to vacancy, the value of the property is now $2.3 million, so been downvalued, and the lender's tighter lending calls for no more than a 65% loan to value. Again, also input maybe some higher debt service coverage ratios, but we'll leave that out of the discussion for a moment, but basically a smaller loan amount. So at the current value of the property, $2.3 million and a 65% loan to value, now we're talking about refinancing just $1,495,000. So if the owner wishes to retain the property and refinance, he'll have to invest an additional $490,000. Remember, the loan balance was $1,985,000. If the new loan amount was $1,495,000, that's an additional almost $500,000 the owner would have to put into the property in order to get refinancing. So many owners are unable or unwilling to put additional equity into the property and may then default on the loan, handing it back to the lender. On the other hand, many of these owners, as their loan maturities are coming up, and they may be coming up end of 2023, 2024, 2025, think 5 years from the beginning of COVID, if you want to take a look at that, 5 years, 7 years, what have you, may be looking to sell their property before the loan comes to maturity, and that's where there could be opportunities for commercial agents. So it's a significant issue in the market, and it's already happening. So as an opportunity for commercial agents, we need to identify the properties that have loans maturing in 2024 immediately, but even looking into the future, this is still going to be happening in 2025, et cetera. Again, I'm primarily focused on office properties. So one of the things we can do, there's a number of different tools, and at eXp Commercial, where I am, we have a tool called Reonomy. Similar information that I'm going to describe. has CoStar, Moody's Catalyst, and some other providers. RealNext provide this similar type information. This is all taken from public information, but what I did was, just as an example, I'm in the Dallas, Texas area, so I just went to the suburb of Plano, which is one of the more significant suburbs in Dallas-Fort Worth area. And for this example, I looked up multifamily properties because there's opportunities. Again, multifamily properties that have loan maturities would be entering into an environment of higher interest rates, and maybe higher debt service coverage ratios, etc. So just as an example as to how to identify some properties, be able to take advantage of this situation as commercial agents and identify sellers who, because of loans coming to maturity, may be, and other reasons, may be more interested in selling their property now, listing it possibly, or just entertaining offers now, as opposed to what they would have been, let's say, pre-COVID. So what I looked up here in Reonomy was just in the Plano, Texas suburb, multifamily properties between 50 and 150 units. Now, these are listed and unlisted. So the vast majority of these properties are not listed. There's a total of 39 properties you can see over here on the upper right. And without scrolling through all 39, because this is just a screenshot, the Reonomy will go ahead and rate the property as likely to sell. So this one has a high likelihood to sell. The one above it is a medium. The one below it is a medium. And that's based primarily on things like loan coming to maturity, as well as other factors, how long they've owned it, etc. But what these tools also provide are the true owners, the contacts. So for instance, if we looked on the tax rolls, the owner of 8100 Memorial Lane might be 8100 Memorial Lane LLC. Well, you know, that you kind of hard to contact Mr. or Miss 8100 Memorial Lane LLC. So contacts are provided with most of these listings. So if we were to click on that and click on owners, we'd see that there's a Mr. Nasir, and I'm not going to try to pronounce his last name, who is the controlling partner with Berkeley. Well, we'll talk about that in a second. And here's an email address. Sometimes there are, and his address, and sometimes there are phone numbers, etc. And if this property is highly likely to sell, might be a great person to contact and see if they would be willing to either list or entertain an offer. And so if I'm working with a multifamily owner who is looking for properties between 50 and 150 units, and that's what I would suggest you do as in trying to identify these properties. Try to identify the properties that fit the profile of an investor or investors that you are currently working with, or maybe a partner or agent is working with. Also, it has information on the debt. We can click over here on the debt, and that's Berkeley Point Capital, I guess. And the loan comes to maturity February 1, 2025. So in a little over a year from now. And so this is certainly a time during 2024 where this owner might be looking to sell. So we can contact him. And if we are working with an investor or investors who would be interested in buying this property, we can tell Nasir that we are working with an investor looking to purchase multifamily properties, and his property at 8100 Memorial Lane in Plano fits the profile of the owner, the investor that we're working with. Would he consider selling? Would he entertain an offer? And that's an easier ask, quite frankly, because we're telling Nasir that we already have a client. We're not asking you to be our client. We're just asking if you'd entertain an offer, if you would be willing, if you're open to selling. Now, perhaps he may also, in that conversation, you may find out he may be open to listing, which would even be better, listing the property with you. But nonetheless, this is a way to take advantage of a current situation and help out some of these owners for potentially distressed or stressed property as their loans come to maturity in a tighter or more difficult lending environment. So to wrap up, where are our opportunities? Well, if we can use Reonomy or similar tools to identify properties that are highly likely to sell, focus on properties that fit the profile of investors you're already working with. It's much easier to make the call to say, I'm already working with an investor who's looking for properties like your property. Would you be interested to sell? As opposed to the call that they probably get all the time, that, hey, I'm a commercial agent and there's a lot of investors out there who might be interested in your property. Would you let me list it? Well, they don't know you, and you're asking to establish a relationship with them. And so that's a much tougher sell, as opposed to, I already have a client. Would you be interested in selling, or would you entertain an offer? So just my suggestion as an approach you might want to take, which I have described here as I'm working with an investor. You can even describe your investors, some specifics about your investor, which adds credibility to this call. I'm working with an investor that currently owns 13 multifamily properties. They're looking to acquire more, and your property at 8100 Memorial Lane fits the profile of what they're looking for. Well, by adding that extra information about your investor, adds credibility to the call that you really are working with an investor. You're just not an agent who's making up a story because you want to list their property. And be aware, and I've been in the business a very, very long time, over 40 years, and been through some really significant cycles, much greater than what we're going through now. And I can tell you, at the right price and with some creativity, almost any property, including office properties, can be turned around, repurposed, made to work. And bottom line, these are the times when fortunes are lost, but also fortunes are made. So hopefully you can use some of this information, take advantage of it, and make some money. So thanks again. I'm Cliff Bogart, the commercial designated managing broker for the state of Texas for eXp Commercial.